This woman makes $200,000 a year, and she's worth, what, $300 million? It just doesn't even make sense.
You know, men lie, women lie, numbers don't.
56% return. The average for the regular folk is 5 to 8%.
And she don't care about none of that stuff because she making a killing. Aunt Nancy, I need a loan.
She knows what's going to happen beforehand. Maybe she is psychic. Yeah, that's probably the most plausible explanation.
We got to throw some disclaimers on this episode.
What's up? This is Keith.
And this is D, back with another episode of the Defiant Life Podcast.
Where we defy the laws of mediocrity.
Let's go.
Man, from the audience over there. That was nice.
Thank you for the peanut gallery. We do have the maestro on the mic today. Introduce the world for the first time.
Young Jamie. No, Russ.
Oh, no.
Hello.
All right.
Russ.
Glad to have him on. He a lot of helpful insight, a lot of knowledge, a lot of drops, nuggets. So, but anyway, man, a little bit under the weather. So if I sound a little bit more like Macy Gray today, then, you know, just trying to get over this little bit of summertime sickness.
Maybe you shouldn't make excuses.
About what?
Being sick.
Well, here's the thing. The fact that I'm here shows that I'm not making excuses.
Okay.
So,
Yeah. That's all right.
Yeah.
Yeah, we've been waiting for a while, though, so whatever.
It's worth the wait. All right, so let's hop into it, man. So, you know, talk to people all the time. Students, potential students, friends, family members, colleagues, and stuff like that. And I'm like, hey, you know, what you doing these days? They ask me what I got going on. You know, real estate investment, coaching, mentoring, things of that nature. And so every now and again, I get this type of response, Keith. People like, that crash coming.
Yeah.
You know, I'm like, okay, Elizabeth, you know, I'm waiting for the big one. Like,
It's the big one.
What we doing?
Yeah.
So here's my question. What do we do in the event of said crash? How do real estate investors fare in situations like that? You know, I want to dig into that a little bit.
I think the first thing is they tend, at least from my research, they tend to do a lot better than people who are invested in the stock market, which is everybody who's criticizing real estate investors
all the time.
So yeah, either they have no money invested at all, or they have all of their money in a 401k or a retirement account, you know, and then they're like, well, you know, what you gonna do when that crash comes? Like, well, probably not lose half of it like you did last time, but you know, whatever.
And that's the truth, man.
Yeah. So anyway, so that's something that we definitely have to think about, and we hedge against, because I was not in the game in 2008 when the last big crash happened. Technically, I guess we are in a recession right now.
Technically.
So it depends on who's defining it, I guess. So anyway,
GDP stuff.
Yeah. Well, it hasn't affected my property at this point, you know. So we'll see what happens. I don't know, but we definitely think about something that we always thinking about whenever we're analyzing property, whenever we're going into deals, trying to figure out what you know, if stuff goes bad, what happens to our stuff. So I think, though, that looking back at the last crash and at what's happened historically, you definitely get some decrease in people equate decrease in property values to decrease in like rental income and that kind of thing. It's not necessarily what's happened in the last few crashes for multifamily specifically. So we deal with multifamily, you know, almost exclusively. So yes, people in 2008, 7, 8, 9, 10 lost their houses. A lot of people lost their houses, right? They lost their property because they had bad mortgages. But multifamily investors actually didn't do that poorly. So this is something I've been researching a little bit. And I found out that there was an increase in vacancy rate, but rents stayed pretty steady. Yeah. You know, multifamily properties did pretty well. Certain types of multifamily actually had really low default rates. So actually, it turned out to be one of the safest things for people to do. Yeah. For people to be invested in during that time. And meanwhile, the stock market lost half of its value, more than half. Yep. So it's a little weird to me when people are like, man, that crash is coming, but then they're like, well, you need to get in that 401k. Yeah. Well, probably not.
What does history show you?
Yeah.
You know, what do the numbers? You know, men lie, women lie, numbers don't. You know. Yeah. I was at a conference, a real estate conference a couple of weeks ago, and the keynote speaker there was saying, in a good market, real estate investors do good.
Mm-hmm.
In a bad market, real estate investors do great.
Yeah.
And it sounds like that's what you're leaning towards saying now,
Yeah, I think it depends, So I caddied for this dude in 2017. He had 1,500 units, and I was just getting into real estate.
Mm-hmm.
And he said the people who got hurt in the last recession were the ones who were over-leveraged.
Mm-hmm.
And so he said, just don't get over-leveraged and you'll be fine no matter what the economy does.
Mm-hmm.
So I think that makes a lot of sense. And I think that's why we look at DSCR and we look at the different financial factors and metrics that are that kind of show you what your risk profile is. So in a situation where our DSCR is really high, that we have a lot of room to move if we have to, then it's going to take a lot to make that deal not work out. And as long as we have good management in place, and there's a lot of other factors, but if something happens and I have I can decrease my rents by half and still survive.
Yeah.
Then it's probably going to take something that's so dramatic that our income doesn't even matter anymore, right? So,
right. So, yeah. You got bigger fish to fry at that point.
How many guns and farms do you have at that point?
How much land you got?
Yeah.
But that's a good thing, man. That risk management. I was talking to a friend of mine the other day, and they're getting ready to start a brand new business venture. And not to venture too far off of this conversation, but they said they have 4 components, they have 4 people that were necessities for this new business venture that they're getting ready to do. They hadn't told anybody about yet. It was them, their spouse, okay, their risk assessment personnel, whoever that is, and their engineer. That's it. And I thought it was funny because they said in their essential 4 people, there was a risk assessment person in there, and I don't think a lot of people really count the cost to that degree. Yeah. So like you were just talking about the debt to service ratio and debt service coverage ratio. Yeah. And doing things by the book. I think a lot of people they throw out these ignorant phrases and they have this scarcity mindset is because they don't really know how to prepare. Right. They don't even know what preparation looks like. So it's like, y'all gonna lose everything and all this stuff. Like, okay, well, savvy and smart people look at history and they learn how to improve and learn so that they won't make and fall into those same mistakes anymore. Yep. So go ahead.
No, go ahead.
I need to drink some water because I'm under the weather. So go ahead.
Good, yeah. Well, that reminds me too. I think that the people who do well are not really banking on the appreciation. They're not in these high risk assets. So like I caddied for another guy. This might have been around 2010. I don't remember. But anyway, I caddied for this guy, and he said that his wife was I asked him what he did for a living, and he's like, man, I don't do anything. He's like, my wife works on Wall Street, and so I just stay home. Like, no kids, just stayed home, played golf. That's it.
Wow.
Yeah, he's like, she works like 18-hour days, so I just play golf and hang out.
Hold on. His wife works 18-hour days.
Yeah.
He stays home with the
no
kids. No kids. So he's not even a stay-at-home father. He's a trophy husband.
Yes. No, what happened was he got grounded for life because he was a house flipper. Okay. And in 2008, he lost everything. Okay. Because he had a lot of flips going on. He had like, I don't remember how much. It was several $100,000, maybe even more than $1 million invested in these flips. And then the market crashed while he was in the middle of these rehabs. Jeez. So then he couldn't sell any of the houses. Yeah. And he wound up losing everything. Yeah. So his wife was like, listen, I'll just make the money. You just don't worry about money anymore. Just stay home. Have fun.
Can I interject a real quick story real quick? Yeah. So I did this intentionally one time, got grounded from washing dishes, right? So I was roommates.
Oh, my God. I have such a good story about this.
I was roommates with this couple one time, older couple. And I was like, hey, guys, don't worry about it. I got the dishes tonight. They was like, okay, cool, right? So I got in there and I thought I know how to wash dishes, right? But my process is just different from everybody. So
how old were you when this was happening?
I was a grown man. I was 20 years old, I think, 19 or 20. I was in college, and I was staying with this family. And I was like, I got the dishes tonight. So I had they only had one sink. So that kind of threw me off a little bit, right? What used to that, my grandma taught me with a two sink system, so work with one sink.
Divider in there or something.
I did. I needed something. And so it had some bleach in the water. You could smell the bleach from across the street, Long story short, they were just like, okay, you are never allowed to wash dishes ever again.
They had to go get all new dishes.
Well, they didn't have to get new. They were very clean, but the process just was not conducive to living and sustaining life, right? So anyway, they grounded me from doing dishes ever again. I shed one tear of happiness, of joy. So anyway, so I can understand. So he probably was living the life, like living his best life.
Yeah, he probably was. But I think he would also felt defeated a little bit. But I have to tell the story about
Go ahead.
when you taught me the trick of looking busy.
Come on, bro.
I gotta tell everybody your secret.
Tell them my secrets.
Listen, we were at my house one time. We were cleaning up. I don't remember. You had come over. I don't remember what was going on, but the house was like a mess. And my wife was like, we got to clean the house. I'm like, all right. And so she started cleaning. And she was like, you got to help me. Come on. D's got to help. Everybody's got to pitch in. So then D was like, listen, let me tell you what to do. Like, the trick is you have to walk with purpose.
Yeah.
And I was like, what? So D just starts walking through the house like, oh yeah. Walk by, pointing at stuff, just walking,
picking up
and
stuff
all he was doing is walking back
here.
and forth. Just walking back and forth. And I'm dying laughing. And my wife is like, what are you doing? And I'm like, I'm just laughing. She's like, you need to help. You need to get to work. What's going on? I'm like, what you mean? I'm just laughing at D. She's like, what are you laughing at D for? He's over there working, cleaning stuff up. I'm like,
working
he
hard.
has not picked one thing up the whole time. What is going on? It worked perfectly, and then I outed him, and then he had to clean.
Oh my god,
it was so funny though.
Yeah,
God, it was hilarious.
Yeah, it was brilliant.
It was one of the funniest things I've ever seen in my life. She was like, D is over there working hard, picking up stuff. I'm like, he ain't picked up one. All he did is walk by you a couple times with nothing in his hand.
Hey, you good? You good? Okay. Hey, all right. Yeah. Keep it moving. You know what I'm saying?
Just sneak out the back door for a few minutes, sit on the chair. Oh man, that was so funny. Anyway, that's way off topic, but it was hilarious.
Oh gosh.
So anyway, I think that this dude though got grounded, and then he felt like he was not worthy, but he also was probably grateful because his wife, he didn't have to do anything, so he was like, whatever, we lost $1 million, no big deal,
Yeah.
So he's like, I'm gonna go play golf at Sea Island now. So
as long as they had a good understanding.
Yeah, I don't know how that affected their relationship.
Right. I was gonna say, if every relationship is different, but
that's what people don't understand. When you're investing for appreciation and you're not getting any cash flow from your property, from your deals, not just property, but that's the same thing with stocks. You're investing for appreciation. What happens if it tanks? Mm-hmm. Well, if I'm investing for cash flow, what happens if it tanks? Mm-hmm. Well, I still got cash flow while I wait for it to appreciate. Mm-hmm. So like I do the deals in a way that if it tanks, I'm still making money.
Right.
So like it matters, but it's not going to ruin my whole life if the market crashes. In fact, it probably is going to present opportunity, which is why that guy said in a bad market, real estate investors do great, or multifamily investors do great, because they're looking for those deals. Mm-hmm. So when I caddied for that dude that told me don't get over leveraged, he was at this point, I wonder if he bought property. We've talked about this before, but he didn't actually. He was like, I got patient money. I don't have to buy deals right now when everything's expensive. I'm waiting for the crash because I'm still going to be making money, and I'm going to have a bunch of cash sitting there that I'm going to go scoop up all these other properties with. Mm-hmm, mm-hmm. So for the people who do get over leveraged and they wind up losing money, that's where you find good deals. You wind up coming in and taking over those properties that are struggling, and then you have huge upside because now you bought it for a discount.
Yep.
You're able to get it fixed up. Usually, we were just talking about this, usually construction is cheaper during these recessions.
Yeah. People
are looking for work. My dad owns a construction company, so he had about 30 guys in his crew whenever 2008, 7, 8 happened. And I remember that dwindling down until he had like 3 guys left. But he was still able to survive and still able to make money, but he had to get rid of a lot of his crew. So he kept like his 3 or 4 best guys. Mm-hmm. And then whenever stuff started to recover, he started building his crews back up, getting more jobs. But during those times, though, construction typically becomes cheaper because you have a lot less construction going on. So if you get into a property when the market's crashing, when it crashed, usually you're able to rehab it cheaper. You're able to get people in, fill up. People still have to have a place to live, so you're still able to rent them. Typically, you're still cash flowing, and then stuff happens and it shoots back up. So think about, you bought a property in 2009 when everything was bad, and then you held it to 2022, 10 years later. That's probably 5x return. You know?
Yeah.
Maybe more than that. So you can wind up with huge returns on these properties if you're willing to wait through the storm and you have a buffer there that you know you're not going to get crushed if something happens.
That's true. And at the end of the day, it's just about having a game plan.
Yeah.
Like, why do people get over leveraged? What was your process? What was your system? What were your metrics and things going into it beforehand that even allowed you to be over leveraged in this deal? You know what I'm saying? Like,
that is I think that happens a lot, man. You've seen these cap rates over the last couple of years down in like the low single digits. I had, when I sold my property, the guy said he had just sold a mobile home park for a 0 cap rate.
I didn't even think that was a thing.
Yeah, I'm like, well, what in the world? He said he sold a bunch of them at 1, and none of them, and this was in 2021, he said none of them had been over 5. And so, like, interest rates were really low at that time, so you could probably still pull a little bit of a profit from a 5 cap or a 4 cap. But most of these people, they're not making any money. They're just banking on the appreciation. And maybe there's forced appreciation that can happen. You can come in and you know, like, there's 20 vacancies and I can fill those 20 vacancies up.
Yeah.
And the only reason that they're not full now is that the previous owner didn't fix the units up. Okay, well, that's fine.
That makes sense, yeah.
But if you're buying a 95% occupied multifamily property at a 1 cap rate and you're just banking, and the rents are market already, then you're just banking on the appreciation happening. And those are the people who are going to get crushed. Yeah.
So to those of you guys listening and watching, a 1% cap rate means that it's going to take you 100 years to pay off that property. So what is a 0%? You're never going to pay off that. Like, what does that even mean?
Yeah, it means basically that the property makes zero money before any debt's paid.
Yeah.
So
God.
Yeah, it has no return. And that, I mean, people do that because they're banking on the appreciation. And maybe there's probably other things happening in these deals. I don't know. I don't know what was going on, but probably that those rents are way under market, so they can come in and just raise the rents to market now. And probably there's a bunch of vacancies, and maybe it's a really distressed property, but it makes no sense to me to come in and purchase a property that doesn't cash flow and just wait for the appreciation while you just lose money every month.
I would venture to say for the vast majority of our listening audience, new investors, young investors. When I say young, I mean young in the game of real estate investment.
Yeah,
you should be looking for cash flow over anything, period, right? Because you're looking for freedom, you're looking for control, and you don't get that freedom, you don't get that control unless you have cash flow.
Yeah,
you know what I'm saying?
Yeah, that's right. You got to have the cash. That's why we invest for cash flow, and the appreciation is great. But we look for cash flow. If we never sell the property, okay, cool. We're just going to be making money forever. That's cool.
Right.
I'm
Ain't nothing wrong with that.
Not upset with that. Yeah. So, like, I'm not going in looking to flip these properties. I'm going in to make money. So, like, a lot of times day one we're cash flowing on stuff. It may be a couple of months. The last deal I bought is a few months for us to cash flow. But, we'll have that done in a couple months, and then we're making money. And even if the rents come down, that's okay. We projected low. We're actually going to be way higher than we projected. So we always project low. So, like, what is the worst case scenario? We always look at that. And so worst case scenario, can we still make the payments? Are we still making money? And then, unless there's an apocalypse, and then
it don't really matter at that point.
Yeah, exactly. If an asteroid hits, then
man, on one of our,
is that the right word? I don't even know.
Asteroid. It depends on, I don't know the correct. Russ, when you use
meteor.
Okay.
Yeah.
There's a circumstance, kind of like graveyards and cemeteries. There's a correct word for each one. So, like, graveyard is a cemetery that is on church grounds, and a cemetery is a burial site that's on its own.
Got it.
Right. So, like, when it comes to, go ahead, Russ. What
All
you
right,
got?
according to NASA,
They talking about cemeteries?
an asteroid is a small rocky object that orbits the sun. A meteor is what happens when a small piece of an asteroid or comet called a meteoroid burns up, entering Earth's atmosphere.
So what's the cap rate on that, though? Can I make a profit on this, or does it cash flow when it hits the ground? I don't know.
That's funny.
I'm just trying to find deals, you know.
Yeah. So you said this is some of the stuff that you've been studying, and so right now we're technically in, depending on who you ask, we are in a recession, right? So how do we know that we're in a recession? Because it don't feel like it. Like I'm good.
Yeah, I mean,
I feel great.
Technically, it just means that GDP is lower than it was, right? For two consecutive quarters, I guess. So, I mean, I don't know. People say all the time the market's going to crash. People have been saying this for a long time. You know, Robert Kiyosaki was predicting it in 2016 and never happened. So, I mean, I don't know. Nobody really knows. I don't even think about trying to time the market. I just look at the deal. If it's a good deal, all right, cool. What happens if everything crashes today?
Yep.
All right, cool. We're going to make money. Let's do it.
And
like, I don't really care what the market is right now because it could go one way or the other. Okay. I mean, it matters. Obviously, it matters. But, like, one way or the other, we're going to be okay,
right?
As long as we do our proper due diligence on the deal.
And that's what you went right into my look. That's my point. With whether the market goes up, down, sideways, it don't matter. You buy a good deal, you buy it the right way, and then you don't have to worry about the major stuff.
Yeah,
you know.
I remember the first time. So I used to trade stocks for a living before the crash, actually. And just a couple months before is when I went back into school. Anyway, I remember the first time somebody explained to me, like, you can make money in the stock market, whether it's going up, down, sideways, doesn't matter. But very few people invest that way. Most everybody tries to buy low and sell high, right?
You talking about shorting the stock?
Yeah, well, there's lots of different ways. You can use options. You can use different strategies to do it. You can short the stocks. But all of this stuff is very difficult, though. It's not the same as buying low and selling high. So that's a whole different discussion. But anyway, you can't. But I remember it blew my mind. Like, how do you make money when it goes down? That doesn't make sense, you know. And then I learned how to do it. And I was like, oh my gosh, this is amazing.
Brilliant. Yeah.
So, but the problem is you still have to time it, and almost nobody times it right. So. I was reading something that said something like 85 or 90%, something, a really high number of like people who try to time the market of these different funds, whatever, they don't do as well as just the S&P. If you just invested in the S&P, that's it, in an index fund or whatever, that's it. You would do better than 90, it's like the 90% of people. And the people who try to time it are almost always wrong. Even the experts, they're almost always wrong. So, like, why even try to time it? It doesn't make any sense to me. Why not just invest in something that's going to pay you, whether the market's up or down?
Right.
And then if it goes up, great. If you want to sell, great.
And that way the volatility doesn't matter.
Exactly.
And here's
it doesn't
the other
matter.
thing, too. Even if you do invest in the S&P, and nothing against that, but still, that's on average is going to give you between like 7 and 9% return.
Yeah.
Right. So, like, with the real estate investment stuff that we look at, like, you're getting better returns than that all day long. You know, it just makes more sense.
Yeah.
To me,
I think the average return is 5 to 8%.
Is it 5 to 8? Okay.
Average in a 401k.
Yeah.
I think that's right. Russ can look that up for us. We got young Russ over there. He can look that up
in the studio. The man behind the curtain.
Who is older than both of you guys, I think.
True. I don't know. Anyway, yeah, it just makes sense. I don't know. The whole idea of a retirement account doesn't make any sense to me, but maybe that's a different discussion too. But from the standpoint of, like, what happens during a crash, well, the stock market almost always crashes during any kind of crash. So, like, the last one was a housing crash, but the stock market lost 50% plus of its value. More than, what was that number? 51%.
The Dow Jones loss was 51.1%.
Yeah,
51%
from 2007 to 2009.
From 07, 09. So
during the height of the crash.
Yeah.
From a peak to the
But
low.
during that time, rental rates went up. So people who had rentals who were invested in property the right way,
Yeah.
they probably didn't get hurt. Some of them did because they were over leveraged. They had bad loans. That was the whole problem in the first place, right? So some of them probably did. The people who invested properly, who actually knew what they were doing, probably made more money during that than they did before. And then if they held through the next 2 or 3 years, even to 2010, 11, 12, when the recovery started happening, they probably made a killing.
And listen, and also they probably acquired a whole lot of property during that time as well,
a whole lot
at cost, you know, because the banks don't want to own property.
Nope.
Right?
They are not interested in owning property. They want to make money on the loan. So
yeah,
they want you to come and buy that property from them.
They would have made that residual on the loan, right?
Exactly. So
that movie, The Big Short, though,
it's a good movie.
Great movie. Talks about that. If you guys haven't seen that, knowing a little bit of this information and then watching that movie, just like, oh man, this makes sense, and it makes it very entertaining. You know, to see that this stuff, like what was really going on, and obviously all the stuff isn't 100% true that's in that movie, the way they portray it, but for the most part, it follows the same storyline. You know. Yeah,
it's pretty good. It's actually really informative if you don't understand what happened. But basically, what happened was these banks were making really bad loans and then packaging them together with good loans and selling them off. And then most of these loans were adjustable rates and people weren't really qualified. And then when the rates adjusted up, a lot of people couldn't pay their mortgage anymore, and they wound up losing their house. Tons of people lost their houses. Yeah. That's a really simplified version of it. Yeah. But lots of people lost their houses, but then investors came and scooped those houses up and rented them back to those people for way more than they were paying before. Yep. So Russ was telling us that
patient money.
Yeah, Russ was telling us that the rental rates went above 30% of household income for the first time in a long time. So like people probably were paying more in rent than they were on their mortgage that they couldn't pay. Yeah. So it's crazy. It's a crazy thing.
That is crazy.
I know a lot of people who in 07, 08, 09, 10, they were at retirement age and they were getting ready to retire, and all of a sudden half of their net worth went away because it was all in stocks. Yep. So maybe that's a lesson. Maybe for me, I'm skewed because I saw that happen to friends and family members, and they lost. It seemed like they lost everything, even though they didn't. But they really did. They lost their ability to retire, to do the things that they wanted to do. They had plans. They were ready to go out and like travel the world and do all this stuff. And then they had to continue to work for another 5-10 years and into their old age where they weren't able to do those things anymore. So they lost a lot, actually. And half of their money went away. Like this money that they've been saving for 30, 40 years went away. And they're not able to live on it anymore. So, like, to me, it makes no sense. It's like we put our money into these retirement accounts that make us an okay return, but not as good as real estate historically. They don't pay you monthly at all. Most of the time, you don't get tax benefits, although you can get some tax benefits. But real estate is almost always a 0% tax on your cash flow, right? So, compared to real estate, relatively, they don't offer the tax benefits that real estate offers. The appreciation is not as high. Like in no way does it just makes no sense to me. I don't. Maybe somebody can explain it better to me, and it'll make sense.
I don't think they can.
No money in a retirement account because it makes no sense to me. You can't touch your money for 40 years,
or you get penalized.
Yeah, or you have to pay a 30% fee. Like I don't understand it at all. I don't understand why anybody would put money into that.
You know, and I had that same epiphany also once I knew some people that lost half of their retirement as well. I know people personally, it changed the way they lived, and not only the way they lived because of the plans that they had, but like their whole demeanor, their countenance changed because something they had trusted for 40, 50 years, right, that was supposed to perform for them a certain way, they were let down in their latter years. And it was, so that's when I saw this happening to, older family member, older friend, I decided during those times, I was like, I'm just gonna have to build my own retirement, because I have more control. I would rather have control over my retirement than some other third party entity that can, or some, amorphous nebulous thing out there, what I'm saying, that can just be swayed by emotions or, whatever. So.
Yeah, and So a big thing too is these people lost all this money at no fault of their own. Like they didn't they didn't make a bad decision. No, a lot of these people had their money in big investment firms that were very, they're like very credible. So like it's not that they picked the wrong manager. Like it's not that they, even a passive investor in real estate, you got to do your due diligence and pick the right person to invest your money with. But in this situation, these people invested with the right people, the people who had the best track record, and they still lost half of their money because it's really not about who manages the money to an extent. It's about like this vehicle.
System.
This whole vehicle crashed. So,
dang.
And then, so like, even people who are active, I know people who lost real estate too, and not even in the crash, just in general. I've known people who have done really poorly in real estate, but they were the operators and they were the ones who made the bad decisions. So they can look back and say, well, I did this and this wrong. That's why it happened.
Right.
But like all these people that I know who had their money in retirement accounts and lost it, they didn't do anything wrong. They were just getting ready to retire, and now all of a sudden they can't, So it's crazy.
Yeah. Well,
I just don't understand the whole process of that. Like whenever I think about what happens during a crash, I always come back to, multifamily real estate is where I would want to have my money during a crash.
Right. Yeah. Because at the end of the day, and it's something that you hear when I was first getting into real estate, even when I was younger, before I was even thinking about real estate, some stuff I used to always hear is people have to always have a place to live,
Yeah.
And even if that's the only understanding that you have about real estate and some security in rentals, then you have that one truth that people will always have to have somewhere to live.
That's true.
Right? Like you don't always have to have your money in stock market and stuff like that, or it's basic, and that's the only premise you need right there. And that's all. I don't know. That's enough for me right there.
So one thing that happened back in, I talked about my dad's company that went from 30 crew members to 3 or 4, whatever that number was. I think it was 3. But during that time, people stopped building houses, and not just houses, but multifamily. All the construction halted. Almost to a stop.
You saw that a lot,
yeah.
Vacant.
So I think that what happened was after that, the recovery in the construction industry was slow, and so now we've been so underbuilt for so long. I don't even see a big crash coming. Now, I don't know what's going to happen, but it doesn't even make sense to me that there would be a huge crash in multifamily, especially, or even in housing in general, because we've been so underbuilt for so long. And that's why people don't understand, like during COVID, everybody was like, oh my God, like, the prices are crazy, rental rates are crazy, all this stuff happened. And we had a bunch of property and we were raising rents and stuff like this. And people got so mad about it. I'm like, listen, you have had a discounted rental rate now for 10 years. Like, it's not that our rate is high. It's that usually there's like a 3, 4, 5% increase every year, right? Yeah. Well, nobody did that for 10 years in some of these smaller markets where we were investing. So now, you're still getting rents that are $300 when they should be $1,000.
Yeah.
And so that bringing that up to where the market should be is not it's not the wrong thing. It doesn't mean that there's a bubble. People say like, oh, now look how high everything is. Well, actually, we're just trying to keep up with inflation. And at the end of the day, that's another thing too with real estate versus something like the stock market. Typically, when inflation is high, the stock market suffers. Well, in real estate, typically when the inflation is high, real estate meets that, or real estate comes up with that. So it's something that happens pretty regularly. But we were so underbuilt for so long. Now we have such a huge demand for housing that I don't necessarily see that going away in the near future. In the long term, maybe, though, because it seems like now our birth rate's low. The baby boomers are starting to die off. So, that's going to happen in the next 20 years or so. I don't know what's going to happen to population. Will it decline, or will we just have more immigration, or what? I don't know. But so that will definitely affect supply and demand. But right now, the demand is super high. Supply is really low, and it doesn't make sense for there to be a crash unless it's something that's artificial, like interest rates going to,
that's it,
50% or something. But even right now, interest rates are way higher than they were a few years ago, and that has brought prices down some. But there's still so many people trading these things. Like houses are still going quickly, even though pricing has come down. Multifamily is still in pretty good shape at this point. And maybe if they continue to raise interest rates and artificially bring those prices down, maybe that'll happen. But it's eventually supply and demand has got to take over. So there's still huge demand for housing. There's still not enough supply. So I don't understand how there could be a huge crash in that specific industry in the near future unless it's artificial.
And here's the thing that I hear when you're saying that, right, is you're telling me what people are saying, right, their predictions and stuff like this, and it's a lot of, whatever chaos in their voice and in their thoughts and stuff. But then you're responding to a lot of that hearsay stuff with, I don't understand why you're saying that, because the numbers say this, the statistics say that, and it just makes me think that most people really don't do any research at all. It's really a whole lot of
feels
hearsay.
like a bubble.
Yeah. Oh, it must be a bubble. The sky's falling.
They heard that in 2008. Now they're like, oh, it's a bubble. It doesn't make sense to me. Rush just pulled up a stat for us: 4.3 million apartment units needed by 2035 just to meet demand we have now.
Current demand. Yeah, right.
We have to have 4.3 million new apartments coming online.
What was it? He said something like 266,000 per year.
Per year to get there, yeah.
Yeah, that's a lot.
It's a lot, and maybe it'll happen, but I just don't see how you have a huge crash in multifamily when you already don't have enough, and you already can't meet demand. I just, unless it's artificial, unless the government steps in and makes it happen. Yeah, because I don't know who that would benefit, but maybe.
Well, that's a whole nother conversation for a whole nother episode right there.
Whatever Nancy Pelosi does, let's follow that.
Listen, don't cancel us.
Listen, what was it? She's the best investor in the history of the world, and it's not even by a few 100%. It's not even close.
Makes no sense. Yeah. Okay, have you ever heard of Warren Buffett? You know what I'm saying?
No, he's not even in the same universe as her.
But I think they just passed some books or something, some laws on the books that certain politicians can't really. I don't know. I gotta look.
That's passed. We have to look that up.
Yeah, we have to look it up to see, because there was definitely low.
There's Reddit, whole Reddit. I don't even know how Reddit works, but there's whole forums where people just follow her trading. Somehow people have figured out how to know what she's invested in. Yeah, and you're just following that 100%. And she's
rich.
This woman makes $200,000 a year, and she's worth what, $300 million?
Right,
something stupid. It just doesn't even make sense.
It doesn't make sense, but it makes a lot of dollars.
Anyway, that's off the top.
Her 1 year returns for her stocks is 45.59%.
I mean, 45%.
Her option returns.
I just want to give her my money to invest.
Nancy,
what was that last one?
Her option returns are 66.7%.
66.7%.
Okay,
so on
average return.
Her stocks are 56.15.
56% return,
bro. So okay, listen, Aunt Nancy. You know what I'm saying?
The average for the regular folk is 5 to 8%.
Yeah. We just talked about that.
She's doing 10x better than most people are in their retirement accounts.
Come on the show.
And one thing people don't understand about their retirement accounts too is that typically you're paying somebody to manage that 1 to 2%.
Yeah.
So you might be making 5. They're going to take 2%. You got 3%. Inflation's 7 or 8 right now. What is
taxed?
So then you're probably going to have taxes depending on what kind of account you have.
Right.
So I don't know, and then they max you out on the ones that are you do have tax advantages on. Yeah. So you can only invest a little bit there.
And she don't care about none of that stuff because she making a killing. She making money hand over fist.
She knows what's going to happen beforehand. Maybe she is psychic,
clairvoyant or something like that.
Yeah, that's probably the most plausible explanation.
Listen, you guys heard it here first. Nancy Pelosi, Aunt Nancy, I need a loan. Is a psychic.
You can't pay her nearly what she's going to get in the stock market. you got a loan for 60%.
It's Auntie Nancy.
Auntie Nancy. There you go.
Nancy. There it is.
Well, we need to implement some anti-Nancy laws on
Yeah.
the books, anti-whatever stock trading, because that's crazy. Like, didn't Martha Stewart get kind of like,
I don't know, man.
Anyway,
I don't
see,
know.
we got to throw some disclaimers on this episode, boy.
It's crazy. Man, I don't even know. But I think that at the end of the day, the people who are talking about this crash and who are worried about it, I think there's a few things. First of all, I don't think that it's overly warranted. I mean, it could definitely happen. I don't think it's overly warranted, but there's a few things you can do. If you're invested in real estate, you're going to invest in real estate, and you think that there's going to be a crash, there's a few things you can do. So let's talk about that real quick.
All right, let's do it.
One big thing is you look at your DSCR.
Yep.
This is just a measure of what your NOI on a property, what your net income is versus what you're paying to the bank, what your debt is. So usually banks are going to look at like 1.2. Right now they've bumped those up to like 1.25 mostly. We look for a 2. We want to have twice as much money before we pay our debt. That's not a good way to word it. we want to have twice as much money as our net income. Then we have to pay the bank.
Then
right?
you have to pay the bank.
So if the property makes $100,000 net income after all the expenses are paid, then our bank loan should be $50,000 or less.
Yeah, you want it to be like a 2-to-1 ratio is what you're saying. Income
and that's
to debt.
super conservative. Like most people are way under that. And so,
for instance, I was just, I'm always trying to learn education and stuff like that. And a lot of the seminars that I've been going to, a lot of the literature that I've been reading, people are saying they want to be at 1.4.
1.4, yeah.
DSCR.
That's a normal thing.
Yeah.
But
let me tell you this though, right? So banks are about at 1.25.
Yeah.
A lot of people, these investors and stuff, are saying they want to be at 1.4. And when I see that, I'm just like, oh, that's
1.4
too close.
is close.
Yeah, I was like, that's too close. And really,
but really, it's 40%. So if you lost
yeah.
40% of that net income, you still be able to pay your payment.
Still be able to pay the payment.
If we lost half of ours, we'd still be able to pay it, right? So
right.
Yeah.
Yep.
So it's not, like at the end of the day, if we're in really conservative investments like that, first of all, we're going to be making a ton of money, and you can only find these in certain markets. That's why we focus on specific markets, right? That's why our whole program is geared towards this type of investing, because you get way better returns than anybody else does. Now that means that if you're just looking to flip these things, you might not make as much if you're just worried about appreciation, but we don't even care about that at all. So we care about it some, but it's not our focus, right?
Right.
So that's one thing you can do. Make sure your DSCRs are high, that you have good margin in case something happens and you have to lower rents, you have higher vacancy, whatever it is. Make sure that another thing is make sure that you estimate high on your expenses and low on your income, right?
Yeah.
You want to make sure that you are going to be able to actually hit these numbers. A lot of people, when they first get into business, real estate, any kind of business, they will project, and I did this. I remember my first business, I was looking at the numbers and I was like, oh my gosh, I can make $30,000 a month. And at that point in my life, I was getting ready to go into a teaching career where the starting teacher in my county where I lived made $29,000.
Right.
So I was like, I can make $30,000 a month.
Right.
And then I didn't realize that, 90% of that goes towards expenses. So the business can make that, right?
Right.
But then I had to increase the business income to be able to increase my income. So so people don't think about that kind of stuff. People don't project very well. So they're going to look at this property and say, oh man, it's 100 units and I can make $1,000 a month per unit. That's $100,000 a month. I'm going to be rich. But you don't think about all the other expenses that come into play. You don't think about vacancy. So you don't think about, a lot of people don't even look at vacancy rates when they're looking at their numbers.
They don't know to look at it,
Yeah, right. They don't know what the vacancy rate should be. And so, and they don't even know how to hit that. So they might think, well, it's a 10% vacancy. I know I can hit that. But then they don't know how to manage the property well. So now all of a sudden they got a 20% or 30% vacancy, and now all of their profit is gone. So there's so much that goes into it, but that's one of the big things you can do. Make sure that you are realistic with your projections, that you are aiming high for costs, because there's going to be costs that you don't think about. There's also going to be, like, you may think it costs this much to replace an AC, but a year from now it may cost a lot more than that, right? So you have to plan for that kind of stuff. So that's another way that you can kind of hedge against this.
And let me say this real quick too. We're talking about the way that the type of real estate investing that we do, what we try to target with our numbers, where we try to be logistically. outside of these bigger markets and things like that. And I know some people listen, and even some of the people that I talk to, they say, man, that sounds crazy. That like we look at deals every week, and we were just looking at a deal last week in our deal analysis class that we did last Thursday, and that DSCR, the debt service coverage ratio, was like 3.4 or something like that. You know, so it really does come down to crunching these numbers and knowing what you're looking at, and actually going through the deals.
Yeah,
you know,
and knowing how to find those deals. You're not going to find that on the market most of the time. So like bigger investors who are just in there just to make a small percentage return, and they're making money on their fees that they're charging. They're not going to ever see those deals because they're buying from brokers. They're looking in different markets than we are. So for the investors who are just getting started, who are smaller, who want to build a higher margin business that's not as dangerous really, then this is the kind of thing that you have to do.
Yeah,
you have to go direct to seller. You have to figure out how to find these deals, what markets, all that kind of stuff.
And it's just building more solid. It's building wiser.
Yep.
It's building smarter, more conservative, and it's building generationally.
Yep.
Also,
picking the right markets is another way that you can hedge your bet, and I think it's a very important part of it too. If you pick a market that's heavily invested in one industry, or that is something that could be destroyed by one thing happening, then that's going to be a big problem. Also, if you're picking a market that's already declining, people are already leaving this place, whatever, you're not looking at those trends, then you can get to a lot of trouble when something goes wrong, because that can just accelerate whatever is going on. So you think about Detroit with the car, car industry leaving there. It's recovering now, but that was a big thing. There's
Alaska, pipeline.
There's stuff like that. Yeah, stuff like that you have to. What is it? Williamsport, Pennsylvania, where
steel, is it
no, that was fracking oil.
That's right. Oil. Yep, that's right.
So, there's stuff like that you have to look forward to, or you have to look at, and it gets accelerated when the economy's bad, and so you have to really think about what's going on with that market. I think that's a big way you can hedge your bet.
Yeah, that's good. And a lot of this stuff, and this is going to be like a little bit of a shameless plug, but a lot of that stuff you just don't know what you don't know a lot of times. And some people really are afraid of the future and what's going to happen, where their money's going to go, what their future is going to look like. And to those people, I tell them, there's nothing wrong with asking questions.
Yeah.
To experience people that have thought about these things, people that have made, put systems and structures in place for the rainy day, right?
That's an interesting thing. When we closed our second deal, the lady that we were purchasing from, I was talking to her about it, and I said, how we kind of picked this kind of real estate because it fared the best in 2008, in the last crash. So I was like, how did this, like, you guys owned through that? So what happened? Like, how did that work out for you? And she said, we kept our occupancy at like 100%. She said we lowered our rents a little bit just to make sure that everything was rented, but we kept all of our stuff rented the whole time. I was like, well, there you go. That's good.
That is good. Yeah.
That's what I wanted to hear.
So once again, looking at that debt service coverage ratio, let's just say they were renting for $1,000 and they had a 2 debt service coverage ratio, right? If they lowered it to $800 or even $750, they're still going to be operating at a 1.75 debt service coverage ratio. You know what I'm saying?
Yeah.
Like everything is still good.
Yeah, they're still way above what most people are.
They still paying their debt and making money.
That's it.
So that's that leverage, that's that coverage, that's that safety, that's that wisdom right there. So I like those, man.
You're about to break into a song right there.
I mean, I'm always ready to break into a song. I see Russ over there get jiggy with it. Will Smith sighting. Okay. Nah. We ain't going there. That joke. Cool, man.
God.
So that's 3 of them right there. We said what we say. So debt service coverage. We said checking out which market, make sure you get to them. And what was the second one you said?
I don't remember. I was on the fly. So.
Yeah, we can rewind that back. There we go.
So one more thing that you can do to sort of keep this, make sure that if a crash happens that you're taken care of, is complete your rehabs in a timely manner. So this is something that, like I was saying, that guy, he's in the middle of a bunch of rehabs. And if that happens to you, and now all of a sudden you can't rent the properties, which is it would be a pretty, you're going to be able to rent them. It's just what's the rate. So like if if you're planning on renting it for $1,000, now you can only rent it for $750. That's a problem, right? So if you got people in year leases, it's a little bit different thing there. But if you're rehabbing the property, you don't want to be stuck in a whole bunch of rehabs when everything tanks, and then you have a bunch of property that you can't sell or you can't get rented or whatever that is. So I think taking care of that stuff quickly is really important. Don't let that stuff drag out. I've seen this a bunch, and when I first started, we did it this way. We just kind of let it. Whenever we got the money in from cash flow, then we would put it back into the property to fix it up. It's not the way to do it. You got to do it as quickly as possible. You wind up losing a ton of money if you do it that way. So if you do it as quickly as possible, you're going to make a lot more.
Yeah.
It also kind of helps hedge your bet. If you're in the middle of this rehab and everything crashes, then you can run into a lot of trouble. But if you've got everything done, or you're getting stuff on schedule, then you're not as open to that volatility.
Yeah,
so.
yeah. And like in one of the stories that you told in the previous episode, getting a lot of those capital expenditures done up front, right? Just getting those big things knocked out, so it's done, so that you can charge full rent or whatever it is that you intend on renting for.
Yeah, what'll happen a lot of times is people, let's say that the rent should be $1,000, just for round numbers. Let's say the rent should be $1,000, but right now it's $700. So then they're maybe they got 20 units to do. So instead of doing all 20 right now and raising those to $1,000, they're going to do this one over here, and then the rest of them are just going to stay at their other rents, and then the next one, and then you got this. Well, that stretches that rehab project out for a long time, and now you're getting less money in the whole time. And what winds up happening is somebody else moves out. Now you got to go rehab this one. Somebody else is going to move out. Something big's coming up. So now this money that was supposed to go to these rehabs is getting allocated elsewhere. And the people who are doing the work are getting pulled away, and there's other things happening. People don't manage it properly. They have these same guys who are doing this construction over here, doing this maintenance over here, and then none of that stuff works very well. And I've been there before. So then you just never catch up. You started with 20, you might get 1 or 2 done, and then you wind up with 18 because for the next 2 years, you might go back up to 20 because somebody moved out. Now you got to go over here and rehab this one. Now somebody tore this one up. You had to evict them. So now you got to go over here and do this.
Inevitable.
Stuff like that's going to happen.
Yeah, yeah.
But if you've got one rehab going on when you should have 20 going on at the same time, or you should be going faster through these, now you've got so much more time for this stuff to happen, and it's really hard to deal with it. And especially if you don't have all the money up front, then you got a lot of stuff that you have to deal with, and then you just never get caught up. And so you just wind up with those same. It might not be the same units, but you still wind up with the same vacancy because you didn't go in and do the work up front.
Yep.
So just go in and get it done up front, and then you don't have to worry about it. If the market crashes, your whole property is ready to go. So you may have to lower your rents a little bit, but you don't have all this vacancy sitting around.
Got to plan for success. Got to count the costs.
Yep.
And that way you'll be protected.
Yeah.
Protected from start to finish.
There you go.
Best you can, ready to roll with the punches. Cool, man. That's all I got.
There you go. You probably just need to get a cigar too,
Probably, yeah. We need to talk about nicotine one day. Yeah.
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 Is nicotine good for you?
I don't know. That's what we need to talk about.
I think I heard that a cigar a day keeps the doctor away. I don't know if that's right.
I think you just made that.
Yeah.
Just now made that up.
Maybe.
Yeah.
I don't know.
Okay, we'll see.
All right.